Well, good morning, everyone. Good morning, everyone. It is Monday morning, May 11th, 2026. It is so good to see you all this beautiful and amazing Monday morning. So excited that you all are here, y'all. I'm in a good mood this morning. Awesome mood. It's been a good morning so far. A great, excellent weekend. I hope that you all had also a awesome and excellent weekend. But I don't know about you. My weekend was absolutely amazing. It was a great weekend. Y'all, we've got lots going on, lots to go over. A very important week this week for interest rates. You can see behind me that the bond market is up a little bit. We're actually very close to a repricing line. We're up 4.1 basis points already, which is not the best news in the world, even though rates did go down a little bit from Friday until today. We're at the 6.375 for the 30-year fixed mortgage. It went from 6.5 to 6.375 because Friday was a pretty decent day. Unfortunately, we've erased all the gains that we experienced on Friday, and when we're actually just even a little bit higher than we were when we started the day on Friday. So we are looking right now at a 4-year high in the 10-year Treasury. And of course, we know if you've been attending these meetings and all of the meetings that this is a correlation effect, not a causation effect. We take a look at the 10-year Treasury because it closely correlates to the 30-year mortgage market, mortgage-backed security. That's why we look at that. It's a correlation effect, not a causation effect. And tomorrow is going to be a huge day for rates. That's when the CPI, that's when inflation numbers come out. Consumer Price Index is going to be out at 07:30 a.m. This morning wasn't the most consequential day or data day. The only thing that we had was existing home sales that actually came in higher than the previous, a little bit lower than the forecast, but up 0.2% for the entire nation on existing home sales. And then we had a lot of commodity data from around the world, oil production from Algeria, Guinea, Congo, Iran, Gabon, Kuwait. So a lot of the countries reported on oil production this morning. And then we've got a few bond auctions this afternoon. Today was not supposed to be a consequential day for the 10-year Treasury, but we are in the negative right now. Tomorrow is going to be a huge day. We're going to start off at 0500 hours, also known as 5 a.m. for those, with the National Federation of Independent Business, Small Business Optimism. They are forecasting that it's going to inch up just a little bit from 95.8 to 96. And then right at 7:15, we've got ADP employment. And then 7:30, that's when we get absolutely everything when it comes to inflation. And then we've got a few Fed members that are going to be speaking tomorrow. Going into Wednesday, that's when we have the PPI, Producer Price Index. That's going to be the input side of inflation. So back-to-back, two very important days. Then we roll into Thursday. We've got retail sales, import-export pricing, which is also an indication of inflation. A lot of Fed members are speaking this week. And then we go into Friday and we've got some manufacturing data and internal production of oil when it comes to America, along with some commodity data. So the two biggest days, it's going to be tomorrow and Wednesday. No idea what inflation numbers are going to come out at. I would say that I don't see a scenario where it does not go up. Everyone is expecting it to go up. The forecast is that it's going to go up from 3.3% to 3.7% on a year-over-year basis. They're expecting on a month-over-month basis for it just to go down a little bit from 0.9, which is insanely high. That was the previous to 0.6. But they are expecting both the core CPI, which strips away food and energy, along with the CPI that covers everything, to go up year over year to 3.7%. Keep in mind that the Fed target rate under their dual mandate is 2%. At one point, they're just going to have to give up on that. But their target is 2%. And we are so far above their target. And even if it comes in under that 3.7%, it's still crushing. It's still theft. It's still way over their target. These people are fools. You know, it's legal theft. There, I did my spiel on the theft of inflation. So these people belong in jail. And that is what we can expect this week. Very volatile week for the bond market going into tomorrow, going into Wednesday. And as we know, the market tends to trade in anticipation of data that's going to be released. So the fact that the bond market is up right now, the yields are up right now, certainly indicates that they are expecting a hotter than expected or hotter than previous inflation numbers. They're trading in advance of that. So if for some reason it comes in right at their forecast, then we could very well notice a drop on the yield because they're actually anticipating that it's going to be hotter than expected. So even if it comes in hot at 3.7, the fact that that was their forecast, we could very well see a drop in yields. And that right there is your economic calendar update for the morning. Take a look at the email that I sent you this morning, because on the bottom of that email that you might not have even read, and that's okay, we're all very busy, it has the summary of the entire week, what to expect this week as far as the economic calendar, and then what kind of advice should you give your clients in relation to what we are expecting this week. Now, next week, we've got a lot of housing data. We've got the National Association of Home Builders Housing Market Index. That's going to be Monday, May 18th. I'm really anticipating that because that's going to give us the new home buyer walkthrough traffic. And I think it's going to come out really hot, really positive. Pending sales are out on Tuesday. Building permits, housing starts out on Thursday. And then Friday, we've got Michigan consumer expectation, sentiment, inflation expectation. Not the hottest week next week. It's definitely focused this week on information that will certainly impact the bond market. But we are at 6.375 right now, and we are still very close to a repricing line. Lenders are not going to reprice unless we cross that green line that you can see behind me right there. And it's about 1 or 2 p.m. and we are north of that repricing line. That's when we can expect some repricing. Otherwise, they're going to wait until tomorrow to see what those numbers come out at 07:30 a.m. I'll take a look at those numbers. I will post a screenshot of that on our internal Facebook page. May very well send you all an email with the update on the bond market and the update on inflation data. Let's go ahead and do what we like to do more than anything on Monday morning, and that's update the single best leading market indicator available for the entire area, and that's going to be the new listing to pending ratio. But before I do that, let me take my 23rd cup of coffee sip. Man, if you are not a coffee drinker, you do not know what you are missing. Please reach out to me. First one's on me. If you are not a coffee drinker, I will get you hooked. First one is free. After that, I'll charge a small fee. But if you are not a coffee drinker, you all are missing out. I'm telling you. It's like, man, love me some coffee. Let's go ahead and take a look at new listings. We are at 1,221 new listings entering the market from May 4th to May 11th. But we know that this information is going to go up a little bit between now and 11:59 p.m. tonight, and then it's going to lock in. So when you get the email tomorrow morning with the update, please take a look at it so you know exactly what happened with new listings. Whoa, price increase. The sucker went up. 235 price increases. 93% of these are new construction. Builders are very confident right now. They're looking at the data. They're looking at the numbers. That's why I think that the National Association of Home Builder new home traffic that's going to be released Monday, May 18th is going to come out positive, because I am noticing builders holding the line across the board. I'm noticing builders, they've done a really good job. You take a look at months of inventory for new construction in places like Del Valley, across the board, way less inventory now than we had a year ago. And you know what, let me do this. Let's also take a look, not at this one, but we're going to go to Insight and Statistics. And let's take a look at the residential inventory really quick. I have to find that first. Residential inventory. Let me make this just a little bit bigger. I wish there was a way for me to get rid of that sidebar. If you know how to get rid of that sidebar, view, show, that easy. And let me scroll down all the way to the back, because if you didn't know this, we've got new construction data all the way in the back. And take a look at the number of new, and right here, take a look at number of active new construction listings. And look what's happening. We've got 8.8% drop year over year. May 2025, 4188. Right now, 3818. And that's going to mark the third month in a row where we are noticing a drop. And it's going up, right? 1.8 negative, 4.8 negative, 8.8 negative. So we've got less new construction right now than we've had over the past 3 years. Let that sink in. Less new construction inventory right now in the past 3 years. So builders are seeing that. And the reason it's important for us to bring this up is because of the renewed confidence that builders have. They know that the market's already hit the bottom. They know that buyers are re-engaging with the market. So the leverage is not going to be as much. And this is a macro statement. Certain communities, your client's going to get a lot of leverage. Everything is community-based. If you've got one community with a ton of inventory, your client will still maintain the leverage. They're still offering incentives. But don't be surprised if you sold a house in one community back in October and they gave your client an obscene amount of incentives, and then you go there right now and they're like, yeah, we'll give you like $6,000 flex cash. And you're like, well, wait a second. In October, you gave us like $35,000. And they're like, yeah, you should have come here in October with this client, right? The market is improving, and we are noticing improvement across multiple subdivisions. Focus on new construction. They've done a really good job holding back inventory, and now they're going to make up for some of the loss that they've experienced. On the resale side of things, if you have been competing with builders, this is also going to be positive for you, because if you've got a buyer that is looking at a resale, looking at a new construction, they were tilted into new construction because of the incentives. And all of a sudden, if the incentives are half of what they were, well, then all of a sudden that resale could very well be a little bit more attractive. So keep that in mind. That's just the reality of the market. The lowest new construction inventory on the MLS that we've seen going back 3 years for the month of May. Yet another indicator that things are very favorable and improving. And take a look at the new listings. New listings are down year over year for every single month going back to August of 2025. So every month we've got less new listings entering the market. Well, why is that? Because builders pulled back on inventory entering the market because they knew that the market was saturated with inventory. So they started pulling back on that new listing entering the market back in August. And once we started seeing that double-digit decrease year over year on the number of new listings entering the market, we could say with a high degree of confidence, and we did, hey, first quarter of next year, we're actually going to be negative in inventory. And that's exactly what's happened. This is that leading indicator, new listings entering the market. Well, then what happens with the lagging indicator, existing inventory? And then when you look at the number of sales, I want you to ignore the May of 2026 because obviously it's a partial May. But take a look. We've got a 7.9% gain, a 3.2% negative, a 5.8% negative. Last year, we had 24. Those were negative. And then we had a really positive December, 8.1, primarily because of incentives. And then we had a 7.9 on the positive side in February. And then the negative year over year is shrinking. We've got 3.2, 5.8. We're going to be positive this month. We're at 52.9. It's only the 11th. We're going to be positive this month. So we're going to have a higher number of new construction sales this month compared to May of 2025 once this is all said and done. But let's go back to the new listing to pending ratio. That right there is a little bit of a background on why we're seeing that 235 price increase side, 93% are new construction. Let's take a look at price decrease. We are at, interesting number, significant number, 1776. 1,776. There's that percentage plummeting from 93% to 88. But keep in mind the reason why it's down to 88 is because the builders just do everything at the same time. Right? KB Home, Lennar, all these builders will say, let's just do a price increase, $5,000 across the board. And then their admin that's in charge of the MLS goes there and they just update everything, plus 5,000 across the board. That's why you see this big spike in price increase happening at the same time. Next week, this number is going to go up. It's going to go back to the 90s because builders do the price increase at the same time. So it's not a matter of being concerned or not. I'm not focused on that 88%. It's pretty much irrelevant right now. We do have to understand the broader context in which we have that 88%. It's not reflective of the resale market, only the new construction market. Let's take a look at back on the market. We are at 191 back on the market, 16%. There's a drop back. We had 2 weeks in a row at 18%. Let's take a look at active under contract. We're at a fairly okay 499. That's not bad. That's a fine number. And now this is where I get 5 guesses. I need 5 people to guess how many pending. Let's get 5 people to guess how many pendings. 5 souls, 5 brave souls to guess how many pending. Okay, we're going to start off with Ryan at 223, followed by Seth at 246. Kevin at a very bullish 399. Sonia coming in at a solid 222. And we've got John D capping us off, closing us off at 301. Let's go ahead and click on this number, see what we've got going on. And we are at, well, it's kind of disappointing. It's lower than everyone's. That's a little bit disappointing. 215. Not really excited about that number. I was actually really confident with that number after seeing the 499 active under contract. I would have put that around the 240s to 250s. Maybe even slightly north of 250, 255 or so. So that's a disappointing number at 215. And we had a great weekend. We only had rain last night. So it's not like we can blame anything like, wow, it was hot. It's because it rained last night. Right? Exactly. That's the way we are in this business. We're like, the weather was too nice. That's what it is. No one wanted to go see houses because the weather was way too nice and they had like landscaping to do or something. Now, the good news is that we started off the week last week. When you take a look at the email that I sent out with the Monday Touchpoint recap at 0.5, that was where we were at 0.5. Now we're at 0.69 right now. So you can see what happens. We go like within a week on how much that number can go up. It went from 0.5 to 0.69. because all the agents are super late when it comes to updating pendings, but we're starting off at a 0.51. Now, let's take a look at last week because we've had, something really crazy is happening here. We continue to have negative on the incoming listings entering the market. So we are way off where we were last year on the number of new listings entering the market. I mean, we've got negative 11.8. That number's not going to change. Negative 7.6. We did have a positive 10.1, but in the previous 3 weeks, negative 6.5, 14.6, 9.5. So we are absolutely negative year to date on the number of new listings entering the market. So much so that when you go to our X account, or if you go to teamprice.com, and you go to market update, you can find that information both on our X account and on market update. We are down 1,121 new listings entering the market. And that's going to be the year-to-date, year-over-year comparison. That's a big number. So we are not seeing that new listing surge that the data pointed to, right? Last year, it's like, hey, 13 some thousand expireds, withdrawns. The leasing market is saturated and we're going to cross 20,000. Every single thing pointed to us crossing that 20,000. And yet this year, it's like we are lagging last year by 4.7%, which is a pretty significant amount. 1,121 less new listings entering the market year to date compared to last year. That's very significant. So as of now, there is no way that we're going to cross that 18,000 or that 20,000. There's no way. As a matter of fact, I'll even be as bold as saying that we're not going to go past the peak that we had last year, and we will review what that peak was. The season is getting shorter, though. It's compressing between peak pending and peak active. It's compressing. So I don't see a scenario where we cross that 20,000. And last year, October, from August all the way to December into even January, everything pointed to us crossing that 20,000. I was very bold in my prediction that we were going to cross 20,000. Right now, it's just not going to happen because we're down by so much and less new listings entering the market. I'm not sure why that is. It is what it is. We're not seeing that increase in new listings entering the market. On the new construction side, I know why that is. On the resale side of things, no idea why that is. But we just have to trust the data. The data points to this, and we just have to trust it. Okay, let's take a look at a few more year over year. We've got 73 more price increase. We've got 134 less price drops. So those numbers are positive for the market. 24 less back on the market. Now, take a look at this. Really interesting. We've got 178 less properties going under contract 2 weeks ago compared to the same week last year. That's not going to go positive. No way we're going to have an extra 178 properties go pending from 2 weeks ago. We'll have 50, but not 178. That number is going to go negative, and it's going to break that 3-week trend where we had positive numbers, which means that the ratio is going to be negative, which is why we have a red dot right there. A red dot means that we are underperforming on the ratio compared to last year. And when you look at this week compared to last year, we're negative 39.6%. That's a really big number. And historically, once we see something that's north of that 35%, chances are we're not going to outperform. So it looks like we're going to have 2 weeks in a row where, where we have negative pendings. Need to drink some coffee. Delicious. Now, we have negative on pendings, but we have also negative on active, our new listings. That's why the ratio is very, very close to each other, because we've got negative on pendings, but we also have negative on new coming on the market. Let's start updating the monthly. And first thing we're going to do is we're going to go backwards in time a little bit. And as a matter of fact, we didn't go backwards in time here. Let's see if that changes. That's going to be from the 27th to the 4th and 469. Okay, so we are adding 10, and let's go active under contract, and that's going to be 660. We're adding 1. Let's go pending the week before, 20th to the 27th. That's 553. We only add 1. 13th to the 20th. That's going to be 624. So that doesn't change. We're good to go on that. So now we're going to go April. Let's take a look at the pendings for April. This goes to 2,081. That stays the same at 0.71. And then this is 2605. That stays the same. So now we can go new listings for the month of May. and that's going to be 1716. Yeah, new listings are going to be so negative this month. 279. Price drop 2338, 89%, very close to that 90. Back on the market 268, 16%, staying steady. If you look at the average for the past 12 months, it's 19%, a little bit less than average. Active under contract 705 and pending. Wow. So when we do the weekly, we overlap the weekends. It's a really solid way to actually compare the main activity of the market is when we overlap weekends. When we do the month to date, there's no overlapping weekends. It's from the 1st till right now. So we're 11 days into May. Let's get a few guesses going here, you all. 11 days into May, how many properties went pending so far? 6-county area, Travis, Williamson, Caldwell, Hayes, Bastrop, Burnet. How many pending properties in the past 11 days? Let's get a few guesses going. 3 guesses. What do y'all think? Let's get a few guesses going. I need 3 guesses. How many pendings in the past 11 days? 500, 375, 355. Okay, there's our 3 guesses. It starts with a 3. 343 month to date. That's low. Sonny was being hopeful. I'm with you. I wanted it to be 500. That's a low number. This confirms what I said last week, is that we are outperforming last year. On pendings, we're positive. On active, we're negative. So all the leading indicators, the activity index, the months of inventory is doing very well right now. We are performing last year, but the market has already peaked. The demand has already peaked. Now we start going down, but so far we are outperforming. We're going to take a look at the daily briefing here shortly. On withdrawn, we're looking at 247. On expired, we're looking at 100. Expired. Let me go ahead and save this. I will email you a PDF of this with a summary of the meeting. And I want to remind you that you can always access the up-to-date new listing to pending ratio by going to Insight and Statistics, clicking new listing to pending ratio. It'll explain all the different ratios, and then you can get the latest and greatest. This will be updated shortly after our meeting. And if you have Austin Metrics downloaded and installed on your phone, which you absolutely should, you must have. Look at that, 5 stars, only 10 ratings. By the way, if you have not rated Austin Metrics on the Apple Store or on Google Play, please do that. Please do that. You can just go to your app store and you can search for Austin Metrics, scroll down and just hit the review. Give us a 5-star and it'll certainly help the app. But all this information is already updated on Austin Metrics, and you can get the latest and greatest on Austin Metrics. So that's where you can find all this information. So let's take a look at the daily briefing. As you can see, active listings down by 0.7% and pending up by 3%. We peaked last year, June 30th at 18,146. As of now, does not look like we're going to cross that peak just based on the new listings entering the market. We are now underperforming last year on the new listings entering the market. 49% of all the active listings on the market have had at least one price drop. That number keeps on inching up a little bit. Active listings were down 0.67% compared to last year. Pending listings, you can see that we are up 3%. That is when the market peaked. The market peaked right towards the beginning of May on the pending side of things, which was great. We outperformed the past 2 years on pending, and we can see that it's now going down, up a little bit over the past 24 hours, but we are not going to cross that other peak right there. Do I want it to cross that peak? Of course I do. I just don't see it happening. And when we take a look at activity index, we are up 2.8%. This is where I'm saying that we had two peaks this year on activity index. We never quite crossed the 25% activity index, but we did have two peaks. We peaked right there towards the end of March, peaked again towards the end of April. And now this is that unique position that we're in. The demand in relation to the supply has already peaked. That's going to backtrack, and yet we're outperforming last year, and which is fine. We have a very short selling cycle in Austin. So that's something to be aware of. Right? I've got 3 listings hitting the market. One of them hit the market this weekend in Sunfield, Buda. This is a discussion that I had with my clients. Got another listing hitting the market today in Morningstar. That's the conversation. Just emailed them a market report this morning. Take a look at this. We need to be ahead of this demand curve. And then I've got an awesome listing that I'm super excited about. It is a duplex, 78731 zip code. Looks great. We can actually condo it out. My client is an attorney. He's willing to do all the condo regime and just get it approved through the city. It can be sold as a duplex. It can be sold as 2 condos, 78731, and we're going to hit the market at 940 on that. Beautiful, beautiful property. So those are the conversations that I'm having. It's great news. We're outperforming last year. Reality, the market's already peaked. So you have to have these conversations with your clients. When you look at the activity index, Cedar Park, Round Rock, killing it. Over 30% activity index, doing really, really well. 940 for both. So 940 is the price of the entire project. So if the client wants to condo it out, I mean, we are super willing to look at absolutely. We can do owner finance, by the way. That's the other cool thing about it. We can do owner finance. Property is a pretty attractive rate on the owner finance deal. So it'll hit the market on Wednesday, but we're all set. Took pictures last week. Got to take pictures of the other unit here tomorrow. But, really, really good. Selling both together only. I mean, ideally, we'd love to sell both at the same time. But if you do have a client that's like, hey, I want to be in the 3-1, it's a beautiful property. Send me, if you've got a client interested, send me an email and I'll share with you. But if you've got a client that's like, hey, I can only buy one of them, you know me, I'm a deal junkie. We'll figure something out. I'll sell one to them. We'll sell one to them, and then maybe you can buy the other one. Just turn it into an Airbnb or something, right? Make some money off of it. And let's take a look at this one. How fresh is the market? I love this one. This is now becoming one of my favorite ones. No, it's not vacant. It is tenant occupied, and I've got the leases and all that. So if you've got specific client looking at it, just send me a note and I will give you all that information. But it is tenant. Both units are occupied by tenants. Really fascinating. I love this data point, which shows us how fresh the market is. And it continues to amaze me when you look at Buda, when you look at Cedar Park. Buda, 38.4% of all the active listings did not exist 30 days ago. Cedar Park, 41.4% of all the active listings did not exist 30 days ago. On the pending side, 31.4% of all Cedar Park pendings. Not that pending didn't exist 30 days ago. The listing didn't exist 30 days ago, and it's already pending. That is a crazy high number. And the median days on the market for those pending, those 32 pending, where the listing didn't exist, it wasn't even listed on the market 30 days ago, is only 5 days. So what does that show us? And this is even across the board, even in areas where the activity index is really soft, really low, really soft activity index, like the Burnet, or let's look at another one, or even Del Valley. Del Valley is 22% activity index, not the best in the world, but you've got 17.9% of the pending. So 5 listings that are currently pending didn't even exist 30 days ago. And look at that median days in the market, 10. what you have to do is you have to go in if you've got a listing that's coming into the market within these areas, and we also have this available for the 75 zip codes. You have to hyperanalyze those listings that went pending so fast, and you have to say, what did they do differently on pricing, on staging, on marketing, on presentation? You have to be obsessed with why is it that those properties sold so much faster, and present your listing, really communicate with your client on, hey, this is your goal, right? Your goal is to sell this property. So this is what's going to be needed to sell this property. Love this resource, super insightful. And here's another one that goes to show you how much of an improved market it is this year compared to last year. This is where we take the year-to-date cumulative and we simply do the new listings versus pending. Now, we are still positive, meaning inventory is increasing. The number of active listings are down year over year, but we do have more inventory today than we had a month ago because that ratio is not anywhere close to 1. Inventory only starts going down one of two reasons. The cycle of the market, meaning we hit June, July timeframe, we notice an increase in withdrawals and expireds, the market already peaked, and then the active listings start going down, even though absorption is not anywhere close to that 1 ratio. Or where you have a situation like this. So inventory continues to go up right now, right? Because we're not at that 1 ratio. And yet the difference last year was 5422 on the positive side. Right now it's 3,029. That's a big difference. That's 2,400 listings, meaning the difference between the new and the pending was plus 2,400 last year, year to date. So this goes to show how different of a market we are operating in today compared to last year, where inventory was just growing, feeling like an exponential growth in inventory. Right now, we have a very tamed growth in inventory, nothing like last year. Let's keep on going. Months of inventory, we're down 2.9%. It is increasing. Last year, it peaked towards the 3rd week of June. 2 years ago, it peaked towards the 3rd week of July. And then, of course, inventory started going down because the number of new listings entering the market drops, cycle of the market. Therefore, the number of active listings starts dropping, just the normal cycle of the market. Therefore, months of inventory starts to drop. We've got 3 zip codes that are outperforming the rest substantially. We've got Cedar Park, Pflugerville, Round Rock. Cedar Park, 2.9 months of inventory. I mean, to put that in perspective, that is almost half of the inventory as like the 5th best city out of 30. Those Cedar Park's killing it. Pflugerville doing very well. Round Rock doing extremely well. On the zip code side of things, we've got 2 zip codes tied for first place, 3.9 and 4.9, at a crazy 1.87 months of inventory. Those zip codes are doing very, very well. And we can see that when we look at the top 30 cities, and keep in mind that we have exactly the same resource for the 75 zip codes, we've got 16 cities that have more inventory this year compared to last year. On Friday, that number was 15. So we did add 1 city to that higher amount. When you look at 2 years, we've got 27. We only have 3 cities with less inventory right now than we had 2 years ago: Lagos, Cedar Creek, and Del Valle. On the year over year, Austin down 17.4%. But we've got Gerald, Bastrop, Buda down 4.1%. And look at Lago Vista, down by 30.5%. We are forecasting over 3,000 sales this month. That's our forecast. We're up year over year, cumulative. We're up when you look at the per 100,000 people. And we are definitely up when you divide 1,000 agents to the number of sold properties cumulative. We're at an 8.7% increase year over year. So overall, a very positive start of the year for us in the business. Pricing's up a massive $30,000 month over month on the median, which so far is the best reading going back years. We're up 7% month over month, and it is the 11th of the month. We do expect this number to go down because more expensive homes do sell at the beginning part of the month as opposed to the latter part of the month. And it did help that some very expensive homes closed on Thursday and Friday. I mean, we're talking about $8 million, $7 million, $5 million properties closed on Friday. It was reported on Saturday, and that just caused that number just to go up quite a bit between the Friday reading and today's reading. Let's keep on going. When you look at the percentile analysis, we are down on the bottom 25th percentile, but we are up 1.6% on the top 25th percentile on price, 0.2% on the price per foot. So far, 6 cities are up year over year on the median sold price. The cities that are up, Bastrop's up, Burnet is up, Lago Manor is now up 0.7% year over year. Smithville and Wimberley is reaching an all-time record high. Wimberley is just off the charts what's happening with Wimberley. Less properties that are transacting, but they're very expensive properties. That's what's happening. So the number of sold properties in Wimberley is going down, but the ones that are selling are really expensive. When you look at all the properties that are pending, days on the market, and everything else, we are looking at roughly 3 sellers per buyer, 3 sellers per available buyer on the market right now. And we've got this information for both cities and zip codes where it gives you the market type. Is it balanced? Is it warm? Is it cool? Is it cold? When you look at the zip code, we've got 4 zip codes that are hot. We've got 29, hot zip code. We've got 39. We've got 49, and we've got 50. Those are going to be the 4 zip codes that are super, super hot. 19 warm, 37 balanced, 14 cool, and 1 cold. And can you find the 1 cold market? West Campus, 78705. There are 10.9 sellers available for every buyer. 10.9 sellers for every buyer. So you take a look at, a buyer that's out there looking for properties, they've got a pick of 10. They're like, okay, which one out of the 10 do I want? That's a buyer that has leverage. You compare that to 1.2. Insane. That's almost like that perfect match. 1 buyer for every seller. That's a hot zip code. The absorption rate, really encouraging. We're at 20.66, far outperforming last year at 18.2. And then finally, the 0 to 10, how's the market? 4.72 versus 3.84 last year. What we want to see is 4 months in a row where the market flow score, which is at 0 to 10, how's the market? 0, garbage, trash, get another job kind of market. Only 1 month in the past 21 years where we had a 0. That was January 2009. All the way to a 10, the market could not possibly be any hotter. Buyers buy anything, $50,000 over list price. We had quite a few months of 10 back in 2020. 2 months in 2021. We're right at that middle, very close to that middle at 4.72. The good news is that this is the 3rd month in a row that we have outperformed last year. What we're looking for is to outperform in May. Historically, when you look at this data, when we cross 4 months in a row, which means a continued year-over-year improvement, that shows us that we're in a market recovery. Now, I am already claiming that we're in a market recovery, and everything is pointing in that direction. If it changes, you'll be the first to know. But every single thing right now points to a continued market recovery. Just a nice, healthy, sustained market recovery. And that's good news for us, good news for our clients, good news for the overall market. Buyers are still able to get way better deals than they were able to get not too long ago. We are still noticing some subdivisions, and it's really fascinating doing listing presentations. You do a listing presentation in 2.8, and then you do a listing presentation in 7.8633, and it's a completely different market. I mean, completely different market. I did a listing in 4.5 where we went up $20,000 on the list price from when I had my first listing presentation to when we went active on the market. I recommended a $20,000 increase in the list price, and we sold it for full price. And then you go to another subdivision, another area, and you're doing the opposite. You're like, hey, I know that when we first met, I told you this amount. Look at what's happened. Look at the active. The market is hyperlocal. You have to be obsessed with your specific market for that listing and what's happening with that listing and what's the profile for that specific buyer. Any questions, you all? Any questions, comments, concerns, criticisms, or complaints? Any questions? You can unmute yourself. You can write it down over chat. Any questions? I have a question about solar panels. Yes, I love solar panels. I have solar panels in my house, and I like solar panels. So please go ahead and ask the question.
Good morning, everyone. Hi,
Good
Dan.
morning. How are you doing?
I'm doing great, thank you. So one of my listings has solar panels, and there is an interested buyer, and he's saying that because the house does not have a battery, that the solar panels are worthless. So of course I did my AI research, blah, blah, blah. And for what I understand, they're incorrect, but I have no clue what they're talking about the battery. What battery?
Okay, so the way that solar panels work when you're tied up with a grid is, and I'll just explain my solar panels. I've got 28 solar panels on my property, and you've got 2 meters. You've got your meter of the electricity that you are drawing from the city, per Nallis Electric in my situation. So you've got your main meter. And then you've got your meter for the solar panel that shows how much my panel is producing. Now, I don't touch a single electron that solar panel is producing. It gets fed directly into the grid. It contributes directly into the grid. A lot of people think, oh, you've got solar panels, you turn the light on, and you're using the electricity from the sun. Nonsense. That's not how it works. You have an alternator that converts the energy from DC to AC, and then it feeds directly into the grid. And then what you have an adjustment on your bill. So it'll say, okay, you drew whatever, I don't know, 5,000 kilowatts of electricity. You drew this amount, but you produced 3,000. So your net use was 2,000. That's what it does. Okay. Now, if you overproduce, let's just say that I'm using 5,000, but I produce 6,500. That's where it gets a little bit tricky. That if you're producing more than you're consuming, which at my house is a impossibility because we keep it at like 65 24/7, and then at night we bring it down to 60, and I charge my car, and every light is on almost 24/7. So that's just the way it is. So, but if you produce more, then different utility companies will give you a credit for your overproduction. So let's say I consume 5,000, but I produce 5,500. Well, most utility companies are not going to give you a 1-to-1 credit on that production. Let's just say that they charge you 10 cents or 20 cents, okay, per watt, and you have a credit. They might give you a third of that. They might give you a fourth of that. Like Nallis Electric gives you like 10% of that or 15% of that. It's a very small amount. So it doesn't make any sense for you to install a system that generates so much more production that you use because it's not going to be cost effective. Well, so then what do you do with that added additional amount? Well, that's where batteries come in. So if you are able to then charge up batteries with that overproduction, and then let's just say you drive a Tesla and you're like, hey, I've got this, whether it's an Anchor system or Tesla battery. I mean, there's a lot of batteries out there. Some of them are absolutely amazing. And you produce that excess. Well, now you're not selling it back to the grid for a fraction of the price. You're storing it and then you're feeding it back into your property. That's where batteries come in. So where I would agree or disagree with that person is, let's just say that someone bought a way over capacity system. Like they just went all out and they are generating 25, 30, 40% more electricity than they're consuming through the grid, but they're getting like this pittance back from the electric company. I wouldn't call it worthless. I would say that it was a bad investment. Hey, how come you don't have batteries? Now batteries are expensive. They're not cheap. So if you want to store, 100 or some kilowatts, or you can't run your entire house out of batteries. It costs you $200,000 worth of batteries to do that. That's not feasible. You cannot run your house out of batteries if you like AC in Texas. Or if you like using the oven or anything like that. But if you're overproducing and you're getting a pittance back, I wouldn't call it worthless. I would say it's a kind of a bad investment. You overpaid for your solar panels. You're not going to get that money back. Would it be feasible to investigate into a solar panel, into a battery option? How much would that cost? What's your return on investment on that? Yeah, it'd be feasible to say that, but to call it worthless is an obscene exaggeration, and I absolutely will not agree with that. Does that make sense?
Yes, I want to get this excerpt and send it to the buyer, everything you just explained.
Is the buyer
So
represented by a realtor or no?
they're not.
Yeah, say, hey, my broker owns solar panels. Feel free to give my broker a call. Here's a cell phone number. And I think if anything, what I would say, it's hey, okay, you're making this statement. What are your thoughts? I'm a big solar panel geek. I love this stuff. If anything, I'm hey, he might be an electrical engineer and he might have a rationale as to hey, for me, generating this excess electricity is a waste because it's going to waste. And okay, well, I see your point. I don't disagree with that, but here's a different perspective. The other thing is, and this is where you get to talk to your client and you have to provide this potential buyer with that resource, which is, hey, the reason we don't have battery is because we still consume more electricity than we produce. So it doesn't make any sense for us to store that which we don't have excess of, right? It's just would you buy a deep freezer if your fridge is half full all the time? Well, no, there's no need for a deep freezer because your fridge is half full the whole time. Where would you need a deep freezer? Oh, if you're constantly throwing food away because your fridge is packed, okay, buy a deep freezer then. Store that for long-term use. But if that's not the case, why need it? So he's welcome to call me. We can do a conference call with you and them. I'm happy to make myself available for that.
Hey Dan, can I add
That's
something?
great. Can we talk off after the meeting if you have a minute?
Yeah, that's fine.
I want to go over the numbers because we got an offer from him, and again, he's not represented, and I can tell you a little bit more in numbers on that.
Yeah,
Hey,
that's totally
Sonia,
fine.
can I add something real quick?
Yeah, of course. Please go for it.
Sonia, is the house in Austin? Austin
Yeah,
Utilities? Okay.
yeah.
Because I have solar panels too, and the way that they do the billing is ridiculous, and then they steal money from you. So I totally agree with Dan, and I would not get a battery. So yeah.
Okay, wait. You would not get a battery, or you would get a battery?
I would not. Unless I agree 100% with Dan says, because for me, even if I produce more and very like 1 or 2 months of the year I produce more than I use, and I never got a credit back because the amount, the tiers that they charge is absolutely ridiculous. But yeah,
Yeah, it's not worth getting a battery unless you are consistently producing more. Like you take not if you're producing more for like 2 months, it's not worth making that kind of investment. If you do like a DIY, you go out there, whether you get like an Anchor Solus or a Ecobee, if you go DIY on battery and you still need to get on an electrician, you still need to install like a sub panel, you're in it for 10 grand at the very least for the battery. So if you're only outproducing what you're consuming for 2 months, what's your return on investment of going $10,000 to $15,000 on battery? Doesn't make any sense. Hey, you're better off buying an electric car and then just charging your car. So that's my thought on that.
Okay, well that helps a lot, but I still want to talk to you
That's
a
fine.
little bit more. Okay, and then I'll see if they want to talk to you. Hopefully they do, because I think that would help them. So I don't know what he did. I'm pretty sure he's retired, but his daughter was there, who's a pediatrician. So she's not an engineer, and she's the one that has solar panels and a battery, but she didn't speak. So I don't know what she knows. My guess is she knows probably as much as I do. Somebody told her you have to get a battery, so she got a battery because they have money, and it went from there.
Yeah,
But I'm
and once
curious.
again, if they are producing way excess consistently, then the battery is the way to go. So everything becomes unique to the property. So if your client is for an entire year not producing more than they're consuming, and they have an average consumption, like I have an above average consumption in my electricity. Like I basically consume like probably the equivalent of like 3 houses in my neighborhood. It's pretty insane. But if they have like a normal consumption of electricity and they're still not producing more than they're consuming, for your client, for that property, it doesn't make any sense. So what you have to do is you have to tell your client like, hey, I need like your electric bill for like the past year. And let's see how much you're consuming in relation to how much you're producing. And if at the peak, they're only offsetting their bill by, let's just say 80%, but then, on the low, it's like 50%, then there's nothing to store. Like it'd be a waste of money to buy battery. There's nothing to store. That has to be data driven, and they have to be provided with that information. Like, hey, this is why we didn't get a battery, because we're not generating enough electricity to store.
Okay. Yeah, that makes sense. And also the thing is that right now, my client, the seller, there's 4 people living in the house. They knew the potential buyer. He said, well, there's only 2 of us. We're not going to use enough electricity. So I wonder if that would make a difference for them.
It depends on the person, right? I mean, electricity, and once again, I'm like the worst person for that, right? It's like my kid takes, my kid times her shower based on when the water gets cold, right? Like that's when the shower ends, is when the water gets cold, right? So every day the kid drains a 50-gallon water heater that is basically dedicated to her room, and then we keep the house at 60 at night and between 63 and 65 during the day, regardless of whether there's 110 degrees outside. And I charge a Tesla. So I use enough electricity for like 10 people, which is horrible. Like for you climate sensitive people, I apologize. I fiercely apologize, but it is what it is. So...
Okay, well that clarifies a lot in my head. I just don't feel comfortable enough to explain it. So I will talk to him and see if he's willing to talk to you, and then we'll set up a chat. I don't need to be on the call unless I'm available. But
that's fine. I'm going to record it anyway, so it doesn't matter.
Oh, okay, excellent.
All
Okay,
right.
thank you, Dan. I appreciate you.
Absolutely. I've got another question. Can you also purchase your own banking to be completely off grid, depending on what utility provider? So like right now I'm Pernalis, I'm City of Leander. In City of Leander, you are not, like I'm not allowed to go off grid. I'm not allowed to detach myself from the grid. Now, what I can do is I can create a subpanel. right? So I can go all out and get $50,000 worth of battery backup, upgrade my solar panel system, add another 12 panels, and then just charge my battery and then use my battery as a sub panel. So then I'm not drawing from Pernalis Electric, but where I'm at with my local zoning, with my local jurisdiction, I'm not allowed to detach myself from the grid. Like I'm legally not allowed to do that. Other areas you are. I mean, if you're more like out in the country and all that, sure, absolutely. I know the city of Austin, you are not allowed to go off grid. So you're still going to have to pay the minimum. You're still going to have to pay like the minimum fees. You can just offset it substantially. Good stuff. Good questions. We usually reserve these for broker Q&A, but I love talking about this. Well, you all, I want to remind you that we do have our Wednesday meeting, our Wednesday training, broker Q&A and meeting. It's going to be just right at an hour and a half. We're going to cut it off at exactly 11:30. I was supposed to fly out to Chicago on Thursday morning, leaving at 5 a.m. And the kiddo and Gail were like, heck no, I'm not waking up at 2 o'clock in the morning. You're used to that. I'm not doing that. Like, you've got to rebook the flight to Wednesday night. So we're flying out like at 5 p.m. Wednesday night. They're like, you're insane that you booked us on 5 a.m. Like 5 a.m., that's like almost the afternoon. It's like, what are you talking about? And they were not happy. So I have to leave like at, 6 or something p.m. on Wednesday instead of 5 a.m. on Thursday. So, but we are still having the Wednesday broker Q&A, contract review, and all that. Kevin said, hey, I'm with him on this one. I'm like, what is it? It's ridiculous. It's like 5 a.m. It's like, I'm like brewing my second pot of coffee at 5 a.m. It's like, good afternoon. It's like, sloth, why are you sleeping in? But you know what? If they're happy, I'm happy, so I'm all good. Thank you all so much for joining. Super appreciate it. Hope you have a great, excellent rest of your day. Let's take a look at the bond market really quick. Holding steady up 3.6 basis points. I'll keep you all updated. If you have any questions, comments, concerns, criticisms, complaints, please let me know. Here to help. Violet said, get a hotel at the airport. Yeah, that would have been a better idea, but I didn't do that. That would have been a really good idea. They wouldn't have slept, though. They were like, oh, the flight's at 5 a.m. No, we're leaving in the afternoon, so it'll work out just fine. Thank y'all so much for joining. Super appreciate it. Don't forget to give us a 5-star rating on Austin Metrics, either on the App Store or on Google Play. And I will chat with you all later. Like I said, super appreciate you joining. And I will see you later. Let's just see. What should we end the